Federal Reserve's latest round of quantitative easing has come under scrutiny by Brazil's finance minister. The US released their third round of quantitative easing last week, buying bonds to raise the bond price and lower the yield. Despite this, Guido Mantega has warned this decision will have a knock-on effect for currencies, creating a currency war with drastic consequences. Mantega has suggested QE3 will only have a positive effect in the States and has been targeted to boost US exports, stating this would only have a marginal benefit in the US as there is already no lack of liquidity and that liquidity is not going into production. Until recently, a string of negative data releases showed Brazil's economy struggling to gain momentum. Despite massive government stimulus and better farming conditions, the country is described by critics as suffering from chicken flight due to its sudden spurs of growth followed by large tumbles. The finance minister did protest to suggestions the country's sporadic growth is a result of ad hoc state intervention, compared to other Latin American countries such as Chile or Mexico, which achieved more constant growth. This week, the Bank of Japan announced plans to expand its own asset purchasing program to combat the country's strong currency. Guido Mantega cited this latest decision that follows fresh QE from the Federal Reserve as proof there is tension and rivalry between the countries, which in turn would cause currency problems, especially for emerging market economies such as Brazil's. Mr. Mantega said, "Currency war is being used by countries that are important, and the quantitative easing that's been done by the Fed has stimulated this kind of currency war. The immediate answer to the US QE is Japanese QE, as Japan has already reacted and will adopt measures to devalue the yen." The finance minister originally coined the phrase currency wars in August 2010 in response to the last time the Fed started to embark on QE. Over the past year, Brazil has tried to boost the struggling economy by cutting interest rates by 500 basis points, which is said to bolster the economy as much as 2% this year and 4.5% the next. The country's president, Dilma Rousseff, has announced new plans to raise import tariffs on 100 foreign products to fend off competitiveness and help local industries and the country's economy. Looking forward, Mr. Mantega has suggested this move, as well as cuts in payroll taxes to lower electricity tariffs and a $66 billion package of new privately operated infrastructure projects, will create better trade relationships between countries and reduce the cost of doing business with Brazil. He says, "This is not wishful thinking. This is something that is already taking place. We are going to continue reducing costs and taxes." That's all we have time for, but click back to the website for more interviews and updates. But for now, have a great weekend.